So how does a business owner know if their company is being run successfully? Well, they have their accountants or their bookkeeper run reports. And the most important reports are called financial statements. We've already talked about one of the financial statements, the balance sheet. So now the financial statements must be done at the end of the year. Now, an owner could ask for the statements more frequently than once a year, like maybe once a quarter, once a month, but they have to be done at least once a year at the end of the year in order to tell if the company's made a profit, because that will determine if they need to pay taxes or not. Financial statements also must be done in this order. The first one is the income statement, which shows if the company made a profit or a loss. The next one is the statement of owner's equity, which just shows you how the owner's equity has changed in the year, and you obviously want that to go up over the year. And then the third one is the balance sheet, which we've already talked about before. Now we'll get practice running these reports ourselves. So why must they be done in this order? Well, as we're going to find out in the next few slides, that when we do the second one, the statement of owner's equity, we need the net income figure. And how do we get the net income figure? Well, you have to create the income statement first. And when we run the balance sheet, we need to know the balance of the owner's equity account at the end of the year. And we get that from the second statement, the statement of owner's equity. So let's look at the three formulas for the three main financial statements. We always start off with the income statement because we want to find out if the company's made a profit or loss. The formula is simple. It's revenues minus expenses equals net income or net loss. Some companies call that profit or loss. So when we're done with the income statement, we can then use the net income to help create our statement of owner's equity. So all the statement of owner's equity is showing it's showing what has happened to the owner's equity account over the year. Now, what's the name of the owner's equity account? It's called capital. So they could have called this the statement of capital. So notice we start with the beginning capital, and what by beginning we mean the capital at the beginning of the year. And then below that, we're going to either add or subtract the things that affect capital, also called equity. So what are the things that affect equity? We've learned that they are revenues and expenses, which are embedded in net income. And we learned that draws decrease equity. And the fourth thing that we've not really talked about a whole lot, but we have done transactions with, are investments. So remember when we had a owner starts a business and they invest cash in the company? Remember how that increased the cash account and then increased the capital account? So these investments are another thing that affect equity, also called capital. Now it's important to note that I will probably be calling these owner investments, but the book often calls them owner contributions. Just realize that owner investments and owner contributions are the same thing. The owner is taking something from their personal life, like their cash, and they're putting it in the business, and therefore it becomes a business asset. So then cash would go up for the company, and then the capital account would go up for the company. So let's analyze on a statement of owner's equity. What do we want to happen to capital over the course of the year? We obviously want it to go up. But some reasons that it could go up are better than others. Would you rather see a company's capital account go up because the owner invested a lot? Or would you rather see the capital go up because the company had a lot of net income? Well, you'd rather have the company have a lot of net income. It's possible the capital account is only going up because the owner keeps investing in it, but there could possibly be no profit and maybe even a loss. So once we're done with the statement of owner's equity, we create the balance sheet. Now remember, these are done at the end of the year, at the least. So it's the end of the year and we're creating the balance sheet, and hopefully you remember that the formula for the balance sheet is assets equals liabilities plus equity. Now look at the statement of owner's equity. Remember, the capital account is the equity account. So which capital account would we use? In other words, which equity do we use? The beginning capital or the ending capital? Now, since this balance sheet is created at the end of the year, you want the ending capital. So this slide is super important. I highly recommend that you write these 3 financial statement formulas on a note card, like a flashcard, and make sure you write them in order. The income statement is done first, then the statement of owner's equity, and then the balance sheet. And besides needing the income statement to calculate your profit or loss for tax purposes, if you're ever going to go into a bank and try to get a loan, they're going to ask for these 3 financial statements.